Essex Property Trust stock, ticker symbol ESS. This stock is down 1% on the year-to-date chart, while the overall market, in this case the S&P 500, is up 7.5%. So that's a big difference to start with. ESS missed on FFO and revenue. For the upcoming earnings, 16 out of 17 analysts expect another miss, so this is looking very interesting. From a dividend point of view, things look pretty impressive, with dividend yield at 4.4% and 28 years of dividend increases. But does this mean that ESS stock is a buy at current prices? Well, in this video I'm going to show you real quickly what ESS does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Essex Properties do? Essex Property Trust is a real estate investment trust that invests in apartments primarily on the west coast of the United States. They acquire, develop and manage multi-family apartments. The company was founded in 1971 and they went publicly traded since 1994, so they have been here for a while. When we check the most recent earnings report, we see that net income increased 36% year over year, which is really impressive. But the total FFO decreased 12% year over year, which is something that I don't like. On the 12-month period of 2022, we see a minus 2% decrease on total FFO, which still doesn't look that good, especially since net income was also down 16.5%. When we check the revenue breakdown, we see that Southern California represents 42% of the total revenue. Northern California represents 39.4%. and Seattle Metro represents 18% of the total revenue. Los Angeles County, Orange County and Santa Clara County are by far the biggest segments, representing almost half of the revenue. It's looking quite good in terms of revenue change year over year, since these three subsegments increased over 10%. The occupancy rate is also looking pretty good, sitting at 96% overall. But keep an eye on the decreasing segment Northern California. Essex Properties is the only multi-family REIT dedicated to the West Coast that's publicly traded. And together, California and Washington represent the fourth highest GDP in the world, so that's a fact that we can't ignore. Essex has 252 apartment communities and roughly 62,000 apartment homes. Only 15% is within the urban area, and 85% is within the suburban area. According to this sheet, ESS is outperforming the peer averages in three major segments. Same property NOI growth beating the peer average with 76 versus 63%. But also with the core FFO and dividend growth per share. They outperform the peer average group. For the 2023 year guidance, they expect to deliver a net income of $5.35 to $5.79, which is a decrease from the $6.27 reported in 2022. So that's not looking that great in my opinion. Total FFO and core FFO is expected to be in the range of 14.53 to 14.97, which is a decent increase versus the results reported in 2022. Revenue is expected to increase at roughly 4% and the operating expenses also to increase 5%, meaning margins are going to decrease a tiny bit in the short term. NOI is expected to increase at roughly 3.6%. ESS has a Baa1 to BBB plus rating, which is not too bad in my opinion. But one of the more important numbers here to me is the net debt to adjusted EBITDA. It's sitting at 5.6, which is a really good number, and this comforts me a lot. I prefer a number within the 5 to 6.5 range. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. ESS is a 14 billion market cap company. PE ratio isn't a fair metric to use with REITs, so we are focusing on the price to FFO, which sits at 15, indicating that it could be undervalued based on this number. Later in this video I will show you my 3 price targets for ESS, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.6 billion, and in this graph we see that revenue went up in the long run. To me this looks pretty steady. Of course there was a small decrease during the lockdown periods, but after things cooled down it started to increase again. Margins are going up and down quite a bit over a longer period of time, and most recently they took a big hit. But in the long run it's going up. However, keep an eye on this number since it's expected to have another hit in the short term. EPS is pretty much the same story, and it has to be said that for a REIT things are looking pretty good. Analysts expect EPS to increase at mid to high single digits in the coming years, and in 2023 it's expected to grow at double digits. Revenue is expected to grow at low single digits, which is pretty much in line with the previous decade, so nothing special to mention here. Return on assets is sitting at 6%, which is below my 10% minimum, and it's the same story with the return on equity. But for a REIT it's looking pretty decent. The most important number, return on invested capital, is sitting at 2.9%, which is a low number, but the good part is that it's a little bit higher than the 5-year average. Current ratio is at 0.88, which is very nice, since it's below the 1.5 mark that I prefer. So this looks also quite good. Historically it also looks pretty good to me. Total debt is sitting at 6 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 33 million, so this doesn't look that good. However, keep in mind that REITs issue a lot of new debt to grow the business. Next to that we saw that debt to EBITDA looks pretty good, so this doesn't worry me that much. Nevertheless, it's still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up in the long run. It looks pretty interesting with the 2-year decreasing in 2019 and 2020. But right after that free cash flow started to increase again. Another thing that is interesting are the shares outstanding. It's going up quite a lot in the long run. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business. And it has to be said that most recently the company didn't issue a lot of new shares. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 4.42%, which is a really good number. Annual payout is at $9.24 and payout ratio is at 67% and not the 140% displayed here. This is because REITs use FFO to pay out the dividends. The 5-year growth rate is at almost 5%, which is a decent number for a REIT, especially since the dividend yield is already at 4.4%. On top of that, they grew the dividends for 28 years in a row, which is also very impressive. Overall, a great looking dividend scorecard, but how about the historical returns? I decided to compare ESS stock with the overall market, in this case the S&P 500. Next to that I added CPT and MAA. On the 5-year chart we see that ESS returned only 1.8%, including dividends, underperforming the S&P 500 big time, which returned almost 70%. CPT and MAA also did a better job than ESS on the 5-year chart, but MAA was the only stock in this list beating the S&P 500. On the 1-year chart it looks pretty interesting, with ESS returning minus 37%, which is of course a big drop. The S&P 500 returned minus 7%, and both CPT and MAA also had a big decrease, returning minus 25 to minus 34%. And it's pretty much the same story on the 6-month chart. Both ESS and CPT had the lowest return, while the S&P 500 again had the highest return with 15%. On the 1-month chart we see that ESS had a minus 8% return, while the S&P 500 did best with only 1% return. So bottom line, ESS underperformed the competitors, but also the S&P 500 big time. But how about some fundamentals compared to these two other companies in this list? We see that there is a big difference in terms of market cap from 11 billion to 18 billion. Enterprise value is also ranging from 15 to 22 billion. All companies have a really high PE ratio, but to me that's not that interesting since these are REITs. Price to free cash flow is a little bit lower at ESS, which is very nice. Revenue growth year over year is the highest at CPT, and the 5-year compound annual growth rate as well. It has to be said that the 2% CAGR at ESS isn't looking that great. Net income compound annual growth rate is the highest at CPT, and ESS has a negative number here, which really does hurt to see. Last but not least is the free cash flow compound annual growth rate. It's sitting at 10% for ESS, which is a great number. CPT has the highest number with 15%. ESS has the highest gross profit margin, but not the highest net income margin. Return on equity and return on capital are way higher at CPT and MAA versus ESS, which also doesn't look that great. All companies have quite some debt, and to me there are no big winners here. The last thing that I want to check are the dividends. Dividend yield is the highest at ESS, which beats both CPT and MAA big time. But the dividend growth number is a little higher at CPT and MAA. But ESS has the most consecutive years of dividend increases. Overall, I think the other two stocks in this list look a little bit better in terms of some high over fundamentals. But how about the future? Is ESS stock a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 3%, 4% and 5%, since I think they will increase their revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 23, 25 and 27%. And for the free cash flow margin I'm filling in 50, 52 and 54. Since this is a REIT, I don't pay attention to the PE ratio, but I will have to fill it in, so I'm putting in 20. For the price to free cash flow I'm filling in 15, 16 and 17. My desired annual return is 15%, since I want to build in a higher margin of safety with these REITs. Usually I fill in 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now ESS is at $209. I hit analyze and we see a lot of red numbers. We have a low price target of 133, and again I'm only focusing on the discounted cash flow value and not the PE ratio. We have a mid price target of $152 and we have a high price target of $175. To me, the mid price target is the most justified here, so that means it needs to drop quite a lot to hit this target. My final conclusion on this stock is that I really like the focus they have on the West Coast. If you especially want to invest in this area, this might be a great dividend stock. But if you check some other companies within the same industry but only focusing on more different areas as well, you will quickly discover that there are some better companies out there. Nevertheless, I think it's an interesting company with a proven track record in terms of dividend. It's looking pretty impressive. I expect this company to be a slow growing but steady company that can bring in a decent amount of dividend. For now, I'm skipping this stock since I think there are better deals out there. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.